Hey guys, Marianne Elliott from 360 Mortgage Solutions. So I've been seeing a big trend with my borrowers lately, and that is around families buying homes together. So that means the kids, the parents are all pooling in their money and their incomes and applying for a loan for them all to purchase a property to live in together. So because I'm seeing this more and more often, I thought I'd do a video on running through the pros and the cons associated with this kind of lending. So let's start with the benefits because there absolutely is some benefits, which is why we're seeing more and more borrowers like this with this structure. So overall, depending on the situation of all the individuals, it can mean that you have a stronger borrowing capacity, particularly if your incomes are quite high and your debts are quite low. Adding people into the loan means that your borrowing capacity would be increased. So that goes a long way, particularly when we look at what the property prices are in the market at the moment. It can feel and often be unrealistic for a first home buyer to try and get into the market based on property prices. However, if they're able to pool in their resources with parents, then it means that they could have a stronger borrowing capacity, meaning they can get the next type of property and own it with their parents. It can also mean getting into the market sooner. So rather than having to wait, if perhaps your parents have the deposit and are looking to buy a home, you have some deposit that you can contribute, but it might not be enough for a full deposit. You can pool your resources together, meaning that you then have enough deposit to buy into the property, meaning you don't have to wait quite as long. It also helps with shared living expenses. So things like rates, building insurance, property maintenance, all of that can be quite daunting, particularly when we are in a cost of living crisis at the moment. So sharing that expense with family members can definitely ease the burden. And finally, it's not just about finance, but having that family support system there. We all talk about how it takes a village to raise a family, and having your support system in the same home can relieve a whole lot of pressure for both sides as well. So if that's all the pros, there are definitely some cons or some things that you need to watch out for. And the first one from the banking point of view is it's a shared liability. So that means the liability goes across everybody. If one person isn't paying their way, unfortunately, it then lands on the others to cover them. Otherwise, you could be in default of the loan and at risk of losing the property. So certainly having open communication and being able to talk through if there's any issues is absolutely vital. It can also get a little bit complicated in the future if something was to change. And this is where I would talk about perhaps putting in a BFA, a binding financial agreement, but at the very least, having a very lengthy discussion about the good, the bad, and the ugly before you have done anything. So that if this happens, everyone knows that's the plan and there's no questions and no concerns. And as long as everyone is happy with what's discussed and what's agreed on, then the purchase can continue. Unfortunately, that challenging conversation absolutely needs to be had at the onset before anything is done so that everybody is crystal clear that if anything changes, what the plans were, who's buying who out or who's selling and what's going to happen. It can also potentially result in some family tension. So obviously mixing family and money can sometimes create a little bit of tension amongst family. So again, I stress having that open communication and being on board and agreeing to everything on the onset can help alleviate that, but it's definitely not going to remove it completely. So being mindful of that as well. And then finally, everybody needs to have an exit strategy. What does that exit strategy look like for each of you? Particularly if it's aging parents, what's the plan when they need to move out and move into some aged care perhaps? Who will buy them out? Will the property get sold? Having all of that in place before you buy just protects everybody. So in short, co-borrowing, I'm seeing a lot more of it at the moment, and I honestly believe it's because the property prices getting into the market is so hard. You can get a lot more bang for your buck when you're co-borrowing with family. But it obviously has its things to be wary of, and you need to make sure that you address it all before you make any changes so that everyone's on board and everyone can co-live happily. Otherwise, guys, that's it from me. I hope you have a fantastic day and I'll catch you next week.